Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for March 17th of 2024. Big news we got last week was on the inflation front. We got the Consumer Price Index, which we're looking at here. We got the PCE, Personal Consumption Expenditures, and we also got the Producer Price Index, the PPI. And and I think the story that it's painting here is that a lot of the easy pickings have been taken on inflation. We've seen a lot of the supply chain issues kind of rectify themselves out. And so all the inflation tied to those really more transitory items have gone away. Now what we're left with is some stickier elements here. And you can see very clearly in these two charts, we've got the headline number and then we've got the core inflation number here. You can see in the red bars represent the most recent month data points here. A time series that goes back to 2016 on both. You can see the relatively benign inflation environment that we witnessed here before the pandemic, and then everything changed. A lot of this had to do with supply chains, and then that kind of worked itself out and reversed itself. And so we had been in kind of a more benign inflation environment as an overall inflation was coming down. Again, these are monthly data points, month over month, and so over the last several months, we've seen an uptick here, even though the number that was reported last week was up 0.4% for the month, and that's actually hotter than what we've seen over the last several months, and it represents kind of a general uptrend. This is what has the market's attention, and similarly on the core side, we have, we were actually up 0.4% on core, which is a little bit higher than what was expected. Again, similar deal. These monthly data points are trending higher, and as we'll see, like if you smooth it out over 6 months and over 12 months, the picture doesn't look nearly as bad. But in a market that's probably a little stretched right now from a valuation side, they tend to hang on these types of data points, and I think really we're setting the tone with these more recent data points that we're going to have higher inflation for longer, which is going to prevent the Fed from decreasing or lowering interest rates for a while. And the probabilities of Fed rate decreases have been pushed out until later on this year. There's a real probability now that we may get less than half of what was expected at the beginning of the year. And I do think that's going to cause some turbulence in the equity markets because it is largely unexpected at this point. Continuing the inflation discussion, here is the 12-month change in the Consumer Price Index, CPI. You can see here, again, 12 months represents the year-over-year basis. Core, we'll kind of talk about, it's kind of like the preferred headline. If you back out food and energy, you can see the general trend line is down. It is at roughly 4%, close to 4%, actually 3.8 to be precise. And overall inflation is about 3.2. Now, that is clearly looking at, relative to 2022, that's an environment that we're a lot happier with, but it's not that 2% Fed target. And so Jerome Powell came out not too long ago and said, it doesn't have to be at 2% to inspire them to begin lowering rates. But the problem here, overall inflation is just kind of meandering around the 3 to 3.5% range. And core prices, again, are higher than that if you back out food and energy. So here's the thing that is impacting the equity markets. Now, really, nobody is expecting higher inflation. So, this is the feeling, this kind of Pollyanna feeling that, we're going to have the soft landing, everything's going to work out, Fed can reduce rates, and we're not going to have inflation. Well, the part that is not necessarily jiving with reality right now is the fact that you run the risk of reigniting inflation if you lower rates too soon. And as we've seen here, rates of inflation are coming down, but not at a pace, I think, that is consistent with what the market is expecting. and consequently, it's not moving at a pace in which the market is kind of correlating into rate decreases this year. And so, I take the positive takeaway from this slide is that higher inflation is really not built into expectations. However, it's going to be important to monitor for the pace of the equity market, in terms of how and when and to what magnitude are rates going to come down. Here we're looking at some 6-month rates of change on the headline CPI. Here you can see headline CPI is kind of like meandering in a band here over the last several months. I'll call this like 6 months here. You can see largely, core is actually moving a little bit higher just on a 6-month annual rate, even though year over year we're looking down. On a more recent basis, it's just inflation's proving to be sticky. That's just the fact of the matter. But if you look at basically food, which is up here in this light blue, and then you've got gray, which is energy. We saw energy prices come down. That was influential last year. Really not much of an impact either way. So, I mean, we've got core prices, that are moving a little bit higher. A lot of this has to do with rents, and we'll talk about that. That's a big part of this number. But overall, we're just seeing inflation be really sticky. And this is what I was talking about earlier, rectifying all the supply chain issues. I mean, this is the low-hanging fruit right here. So we really shaved off a lot of inflation. But the fact is, we're stuck in this channel right now. And that's created a level of frustration for people that are looking for that opportunity for that first rate decrease. Now we'll look at core CPI. You can see, just as we saw in the headline number, the spike in inflation and then the corresponding decrease. And this is what has the markets goat a little bit right now, is that we've seen this uptick. So inflation is sticky. It's not moving in a consistent linear pattern down as it was for quite a few months. And in fact, having moved up, even though you look at it from a year-over-year basis, again, this is a 6-month annual rate, year-over-year may look a little bit better. The near-term data is suggesting sticky inflation. Again, as we look at the subcomponents of this light blue line, rent, owner's equivalent rent, you can see the influence here, very profound. And then obviously there are other things that go into it, but you look at new and used cars and health, those have been less impactful to the equation. And we're going to look at rent in just a second. Well, we've known this for a while. We look at inflation through a couple of different lenses. There's obviously the inflation that's driven by goods and inflation that's driven by services. And services are frankly more important to our economy. And the biggest component of that happens to be labor. We're going to look at a couple slides here that kind of breaks down goods and services. But as we can see here, 2018 pre-pandemic. Pandemic starts here. Then we saw, core goods prices really spike. This is supply chain issues, et cetera. And then that really reversed itself. And so, we have not been talking about goods inflation for a while. In fact, we've been talking about goods deflation, as a matter of fact, even though in the last data point, it was up ever so slightly. But you can see goods inflation has really been it's really been more of a story of deflation for quite some time here. But you can see the black line represents core services prices, and even though those have kind of come down a bit, you can see the overall impact, and they're stuck at like 5% here. And we're going to see this again in a second, that service inflation is really the bugaboo right now. Here's a chart from Bloomberg that kind of breaks out basically the services is in the amber line here. You can see services remains high, as we were talking about, 5.2%. You can look at commodities, less food and energy, that component of the CPI, and that's an outright deflation right now. So when you look at goods, which, this serves as kind of a proxy for, we've just talked about that in the last slide, that is clearly an issue, or excuse me, that's a benefit. It's a tailwind, frankly, for lower inflation. Services inflation is still very sticky at levels that are less palatable to the Fed. We'll look at CPI from a rent perspective. You can see this rather noisy set of data, again, going back to 2016. You've got basically month over month rent changes, and this is rent of primary residence. And down here we've got owner's equivalent rent of primary residence, and I won't go into the nuances here. They both get you to the same conclusion. That this downtrend that we saw over many months, in fact, over really the last 15 months, that seems to have stalled a little bit. In both cases here, we've seen a little bit of an uptick in OER, which is actually the number that's embedded in consumer price inflation and represents over 35% of the core CPI. Now, we're going to transition over to Pantheon Macro here, and they've got data that overlays, the CPI's OER month over month. That's on the right-hand scale here. And so you can see that trend is moving down. You've got CPI primary rent, which kind of goes to, this data set right here. That's also in decline. Now, you've got the Zillow Observed Rent Index, and this is where the market disconnect is really apparent. These are actual rents that are observed in the market. This isn't empirical data or calculated data. This is actually what's going on in rents right now. And we almost got to a point of deflation, but we know that rents, the observed rents had been coming down for a period of time. Now they've moved back up slightly, but this is advanced about 17, 18 months. And so you can see the tight correlation here that you would expect the CPI components that are tied to rent to also come down at some point. And so, the observed rents tend to be a leading indicator for that. And so this is what gives me some hope here that, the stickiness in service inflation, the stickiness in rents that drives service inflation is actually going to abate here in the coming months. And so I do see the prospect of rate decreases. I just think they're going to be fewer and longer to come by here in 2024. And I think actually the issue is that 2025 may be the year in which we get the bulk of these rate decreases. We'll look at producer prices. A lot of data on this slide. The left-hand side is all PPI. This is monthly data. Again, actual observed data for the most recent month, which was February. That was higher than expected. We've had PPI disinflation, significant disinflation, and that has seemingly reversed itself for at least 1 month. 1 month does not make a trend. Here you got core prices that were high last month, and in core and all in PPI was definitely positive after several months of decline. So and then we have core PPI excluding trades and services here also high. Again, this is a 2-month phenomenon really, where we've seen higher than trend line data, and obviously the trend line here has been largely down for quite a few months now. And so this has the market's attention, just like we saw in CPI, that the lowest hanging fruit has been picked, and it's just going to be a little bit of a slog to get down to preferred inflation levels, but I do think they're heading in the right direction. Now, transitioning over to the right-hand side, we've got core PCE, which is personal consumption expenditures. This is what the Fed looks at, basically, and this is another iteration of that, the super core PCE, and this is a kind of a nuanced definition of PCE, but you can see, here that it remains elevated from a monthly standpoint, but it is coming down, and so I think and this tends to come at us with the same amount of frequency as the data that we get from PCE or from PPI and CPI, but I think forecast levels are for that PCE related inflation to come down, and again, I think the data is very consistent that it's high right now. It's going to be a little bit of a near-term struggle to get there, but I think we will if we're patient. Now we'll look at retail sales. We've been talking about this for a while. We had a very weak number in January that seemed to reversed itself. The market was actually looking for a higher number, so we kind of fell short of expectations. And then in the control group, which is again a subset of this data, the survey number was for up 0.4%. We actually got flat retail sales. So, by that definition, even though we saw an uptick in overall retail sales, that, looking at control group, looking at the overall retail sales picture, it fell short of expectations. And so, and I pulled something out of in MBF economics, this actually in the Daily Shot publication. It just looks at, core sales going down. And this is basically the first quarter of 2024. This is kind of like an estimate. Well, no, actually, it's not an estimate. It's just a compilation with 1 month left to go in the quarter. That it's negative, and you see the downtrend. And so what they're talking about is a slowdown in goods consumption, which would help drive that goods inflation number down even more. And I think this is a very real prospect here. Look at freight rates and truckload, freight index. I mean, this is truck-borne freight as well as other modalities of freight transfer. You can see those rates are coming down in both cases. That's not surprising, just as we saw on that prior slide. We might be foreshadowing a decline in goods demand. Here we have some data on credit. What's really interesting is, I think there's a level of optimism that's permeating the market, even despite some of the sticky inflation data that we're seeing, and the prospects of slower goods spending. But, concerns about bank credit have clearly kind of normalized here. Again, this trend line goes to 2010, pandemic here, kind of. This happens to be, the Silicon Valley Bank regional banking kind of shock that we saw in March of 2023, but that's normalized, and so we're at a level here. Concerns, I guess, as a headline would suggest, that like bank credit concerns have really gone down as of late. So kind of channeling that conversation about bank credit, we see here the NFIB, the National Federation of Independent Business. This is the proxy for small businesses. And we have to take stock because there's obviously a lot more, a multitude more of small businesses than there are the large public ones that report earnings every quarter. And we can see their earnings is going down. This is an index. We clearly see that that's, at best, downtrend over several years. But, as we look more recently, you can see that that's kind of stuck in a band. You also see over here, we've got a couple of data series kind of overlaid, which are pretty telling in the sense that there's a pretty high correlation here. That we see in the blue line represents unemployment. We know that unemployment's ever so slightly ticking up, but we're still close to multi-decade lows. But we also have in the red, this is a survey question for the NFIB constituents. What is the single most important problem? And this red represents the percent of responses that say that poor sales is the most important problem. And you can see that that is picking up. And so, the feeling here is that if sales are going to be a concern, then hiring is going to be also a concern, wanting to manage your staff for the level of expected sales. And if you've got business earnings that are kind of stuck, and you have sales that are becoming increasingly a little bit of a problem, then you're apt to not hire as many people, which would seem to create a little bit more strain in the labor market. So carrying forward from small business hiring intentions here, we look at the share of management teams that are saying that labor is tight. And so that number continues to go down. So what's really interesting here is that, we know that the labor market's tight, but when you have management teams that are saying, listen, the shortages are not as acute by virtue of this number continuing to go down, that just means that, a couple of things, either that labor is in abundance, which we know is not true, or that their hiring intentions seem to be tempering, which is the more likely of the two cases here. Here we have labor force participation. This feeds into the tight labor market. What's really interesting here, that we saw from 2000, the pretty compelling data that we saw a real spike, as longevity increased, average, age, working age increased. This is the whole argument about, expanding the age of retirement as defined by Social Security. Well, then we plateaued here at about 40%, and this is the participation rate of those people 55 years of age or older. And then pandemic saw a lot of people that just left the workforce, and it's been a little noisy since then, but we're really stuck at this 38.5% level, which you clearly see is below this plateau that really has persisted since 2009. Well, I think we have to spend a couple minutes talking about productivity, because I think when we get into next year and we look back on 2024, we're going to say that this is a year for productivity. And productivity, it helps to keep a lid on inflation. It doesn't necessarily cause it to fall precipitously like some people have expected, but it does keep a lid on it. It is positive. It is a reason why hiring intentions may fall a little bit, because you're getting more output per hour of worker time here. And you can see here it's depicted in both of these charts. So, and we've got a chart from KPMG, one from B of A. We have this pre-pandemic trend line. And so we know that in the aggregate, productivity is picking up. So that's a positive. When we look on this side, we have revenue per worker, and this is basically going back to 1986 and indexing everything to 1986. We had a multi-year increase. Then we had a global financial crisis that kind of reset the bar. And then we've been working in kind of a channel to some degree over the last, call it 15 years henceforth from the global financial crisis. And we've seen this spike up. So we're at all-time highs after basically, no net gain over 15 years. And so, these two things are pretty powerful. This, I think, but it correlates to what's going on in artificial intelligence as a productivity driver. It's more automation. There's a lot of things that are moving forward that are helping to drive this productivity, and to the extent that this circumstance persists here, that'll help keep a lid on inflation and really be positive to our overall economy. We've got a few things to kind of hit on the economics front before we jump into the investment markets. You can see here, crude has gone back up, and also on the commodity front, we've got iron prices that are dropping. Some of this has to do with goods and manufacturing. But this is a pretty compelling drop as much as this is a compelling rise. Here we have national gasoline prices. This is out of Bianco Research. You can see that we're up at 3.45, 46 a gallon. You can see that mercuric rise, and this is, let's just keep in mind here. This is December, January right here. So I mean, we've seen a fairly dramatic rise in percentage terms in a relatively short period of time. Here we have kind of the impact on households of several different things and things that we really need to be watching over the coming months. And here we have the impact of higher interest rates on the overall household situation. We've got debt service ratio here in this dark blue line. Really hasn't been impacted. So higher interest rates, at least not yet, has impacted debt service ratios, although we know that there's been more net borrowing, so you can see that little tick up. Similarly, in the financial obligations ratio, which again, it was in significant overall decline over more than a decade after the global financial crisis and before the pandemic. And so we're basically back at those levels here in a couple of these cases. You slide over to the right, clearly this is potentially apt to change because of what we're showing here on the right. And these are the average interest rates on various forms of consumer credit. And you can see the dramatic increase in all these, the most poignant of which is credit cards, but also we've seen on new cars and personal lines of credit. And you can see here this would be outstanding credit weighted interest rate, taking all these things into consideration, 15.5%. And you've got to go back, this is 1999. I mean, you've got to go back a long way before we saw kind of weighted average rates like this. And this is partly due to the financial industry wanting to gird itself against any type of credit issue. So we're going to still talk about the consumer here. We've got spending, which we know has softened on the lower incomes, but we see higher income spending really kind of almost turn negative. I mean, and it's not necessarily at the higher levels because of some type of economic fear, because there's actually a lot of optimism priced into, almost exuberance priced into the market right now. And you can see that this is important when you get sluggish spending on the part of higher income earners, because the highest cohorts of incomes tend to do most of the spending. You can see that very concentrated here when you get into these higher deciles, that they account for a lot more of the overall spending. So this is important right here. So we have sentiment, which also plays into this too, right? So we just said that higher incomes are not spending as much. And you look at this chart, and this is basically Michigan consumer sentiment, and you can see that the top third is reacting a little bit better than the bottom third, even though both have gone up. And remember from our conversations from many months ago that the Michigan consumer sentiment number is impacted a lot by inflation expectations, and as we saw very early on in the chart back here, that the inflation expectations are pretty nil. So you'd expect both of these things to be moving up, but clearly what we're seeing is better optimism on the part of the top third of the households by income. Here we have a financial profile of the average household. You look at this, like this is 1999. Then we go right before the global financial crisis, and then right before the pandemic, and then where we are now. You can see that basically as a percent of disposable income net worth has gone up considerably in these periods. You see liabilities, are really in check. So even though we've got, credit card balances moving higher, and obviously the interest on all that's moving higher, we don't see a liability problem for U.S. households. And as a result, we've seen more value in the real estate sector, so owned homes and things like this. This used to be a much bigger piece of the overall net worth, but people have more money in the stock market, whether it's in their IRAs, in their 401ks, or in individual taxable brokerage accounts. And this represents other defined benefits and other equity and business type things, and then you got this whole, general other category. But you can see the assets have gone up, and assets as a percent of disposable income has clearly gone up. So this is, kind of evidence here when we talk about the health of the consumer. This is something that we look at. We'll talk about the investment side for a bit. You've got this optimism that's very much priced into the market. This is a high yield credit spread. So, the credit spreads are going to be really wide when you feel like you're going into economic stress, and you may have more defaults by these high yield issuers that are generally of lower credit quality. That's not the case right now. This has consistently moved down, and just as we exited 2022 and we felt like 2023, that we were going to see maybe some reversal, we saw yet more tightening. And then the market is incredibly tight right now. There's a lot of exuberance and a lot of confidence is priced into this part of the market now. And this is basically the spread between U.S. corporate single B and then double B spreads to, I think actually this is a composite of B and double B spreads to U.S. Treasuries, and you can see that's a really, really tight environment too. And you got to go back to 2014 really to find something of the ilk that we have right now. Market's very confident, and high yield has really done well from an investment standpoint as of late. Now I want to spend a few minutes kind of talking about the private debt and private credit markets. And what we've seen here is a rather dramatic rise as we've gotten to 2022 here, and then looking out into the future over the next 5 to 7 years, we're looking for a really strong increase. And so as we talked about, like banks pulling in credit and maybe some small to medium-sized businesses not able to get traditional bank-based credit or going to these private markets. And you can see private debt assets under management, have increased dramatically in a short period of time, are expected to really mushroom over the next several years. Now, looking at it from an investor standpoint, it's actually very attractive because you're able to get better rates. And this is market yields in the U.S., 0 to 20%. You can see Treasury and T-bill rates we know have moved higher and kind of remain higher for the extent that the Fed's going to be on hold on interest rates. But you get over here to the private commercial real estate market. You get into direct lending, and then also on the asset-based financing side, on the private side, you can see that yields are much more attractive. And again, as we saw in the last couple slides with credit spreads being so narrow, that this is a really attractive area now, because if you're not expecting a lot of defaults, you're expecting credit quality to hold up, this is a pretty attractive part of the market, especially if you consider that long-term S&P 500 returns around 10%, and you're able to get this to help diversify your risk. That's pretty attractive. So on the left-hand side, we've got loans and leases as a percent of total bank assets. And you can see that has trended down a little bit, even though it's come up here more recently. This is data through Q3 of 2023 directly from the FDIC. But you can see, like, survey private debt fund borrowers, why, and I think this is pretty interesting. What are the reasons why you chose private debt? And you can see, basically speed of execution, certainty. They could achieve higher leverage levels, meaning that they could borrow more as a percent of the total project, and then more flexibility, and stability of the relationship is also pretty interesting. And a lot of these folks obviously couldn't get traditional bank financing, but the reasons extend well beyond just, this is the place of last resort for a lot of people. This is actually a preference. And as you look at the debt market that we saw in that last slide, we're going to see an explosion in this non-bank credit environment, and it's going to provide obviously a lot of benefit for small businesses that are otherwise it's going to be tougher for them to get bank financing, but it's going to provide really attractive options as far as the asset class goes from an investment standpoint. So here we have some debt maturities of various forms of commercial loans that are tied to the real estate sector. Here is office. We know that for a fact that we have overall office debt maturing this year about 500 billion. You can see that decreasing down, but still about at least 450 billion by the end of 2027, and a lot of that is office, but not all of it. Here you see the relative impact here. Basically 1 in 5, or around 20% of the maturing commercial real estate debt is related to office, and we know how much strain that we've had here. So is this going to create some opportunities? Well, it might. When these loans roll over and potentially properties change hands, but once we get past 2027, then we've kind of traversed that maturity chasm, if you will. But again, these types of things help to create opportunities. Now we talk about the equity markets. Got a bunch of slides here. Basic takeaway here: this is S&P 500 revenues, ex energy, inflation adjusted. We can see that has moved higher. So this has been some of the feedstock for market activity as of late. We've had a lot of inflows into the equity market, tremendous amount of inflows. This is actually, if you go back, you got to go back prior to 2017 to see something really that strong, although we had pretty strong inflows kind of post-pandemic. But this has been a pretty pronounced change, really reflecting the positive sentiment that's out there. So here we have S&P 500 earnings. Dividend yields are really low right now, and there's a growing preference on the part of publicly traded firms to do buybacks. And you can see here with earnings moving higher, there's a pretty tight correlation between earnings and buybacks. And you would think that we're going to get more of those buybacks here. And this is Deutsche Bank research piece. So this is their forecast for earnings, and of course, Goldman is more like that, and JP Morgan is more like that. But everyone's looking for higher earnings, and you would expect repurchases to follow in kind. Here we have a chart that kind of confirms what we were talking about several slides ago when we were discussing the household net worth as a percent of disposable personal income. So households, by and large, have more equities than they did, and that was a phenomenon that really took hold with the advent of mutual fund, or the proliferation of mutual funds. Even though mutual funds themselves have been around since 1940, but the 1980s witnessed a real increase in the number of products, and that really mushroomed throughout the 90s here. We had the debt bubble, and of course that reversed, and then we're back at those levels, and we've actually exceeded those prior peaks. So this is a household allocation to equities as a percent of their financial assets. So more people own stock, and I think what that does is inherently make perhaps the market a little bit more volatile because it is deemed that institutional investors tend to be more methodical and kind of diligent in their research and their trades, whereas households can tend to be a little bit more pragmatic and impulsive. So from a valuation standpoint, we know that large cap stocks, as dominated by technology, are maybe a little bit stretched here, overbought and overvalued, as this slide would suggest, and I do agree with that. Here's a 12-month forward PE ratio, which is not necessarily as big as it was in 2021, but it's still a huge premium to the average. And but in this type of environment, this is data from MSCI. We slide over here to this chart from Bloomberg that when we have a circumstance like this, that markets tend to spend a longer period in this environment. So, when you look at and this tends to be consistent across all of the major global indices. We've got the Nikkei, we've got the FTSE, we've got the Euro stocks, and in every case, the market's going to spend a lot more time when we have a relative strength of greater than 80, which is what this kind of represents here, than if relative strength is pretty low. So, continuing the conversation on this exuberance that pervades the market right now, we have the Investors Intelligence Survey of stock newsletter writers, and this is probably one of the more nuanced data series that I'm ever going to look at. But this is basically the optimism that's being conveyed by newsletter writers, and that's pretty high right now. And you can see how it does come and go, over time, but this exuberance has really picked up in a pretty short period of time. You got to go back here, 2022. They were very pessimistic and quickly changed their tune, and so newsletters now are very optimistic. So as we're talking about valuation, a lot of it is coming from semiconductors. I thought this chart was really interesting from B of A, that this is a semiconductor, the SOX index here relative to the S&P 500. And obviously back in the tech bubble, as that name would suggest, techs were really overvalued relative to the rest of the market. And guess what? That's the case once again. So we talk about the Magnificent Seven that have high aggregate valuations on a historical basis. Here we are again. So this too would portend, along with overall valuations, I think the opportunity for maybe a 3 to 6%, sell-off or correction here to kind of get us reset. More evidence of perhaps a frothy market here. You can see that this is the market cap of the largest stock in the index relative to the 75th percentile stock. So this is a relative valuation metric. You can see 2000, we just showed you on the technology side that from a relative standpoint that we're back at those levels. Well, looking at it on this metric, I mean, we're out in nosebleed territory on the order of 1932. So, this is not a scare tactic. It's just saying that, we are, I think, potentially exposed to a bit of a correction here in the equity markets. Here we have basically the rule of 20, if you will. This is a chart that was published originally by Liz Ann Saunders at Charles Schwab. So if you add the S&P 500 index price to earnings ratio to the inflation number, if you're if you're below 20, the market's relatively attractive. If you're above 20, it's relatively expensive. Well, guess what? We were at the beginning of 2022, we were pretty high. We sold off, continued to sell off, but then we turned the corner here at the end of 2023. We all know that the market kind of bottomed out in October and kind of rebounded, and last year was relatively good. And so we see that in evidence here, but by no means, at least by this measure, the rule of 20, are we attractively priced here. And as we kind of get close to the end of the chart pack here, just a quick comment on the U.S. market cap to GDP relative to the rest of the world. And so, we're 170% the value of the market capitalization of the U.S. market relative to GDP. We're at 170%. Basically the rest of the world is a fraction of their GDP. And so herein lies the opportunity for international stocks that have, witnessed tighter correlations in the past. And so there's a huge value delta between these two right now, not only from this metric, but also from a valuation price to earnings standpoint. Just feel really good about long-term international investing. Lastly, we look at liquidity, which is essentially the Fed's balance sheet less reverse repos and cash held at the Fed. We do see that liquidity is moving higher. That's a reason why stocks are in motion, and this comes after a period of time where the Fed has been trying to reduce its balance sheet. But you see anytime you have liquidity injections, net liquidity injections in the market, you tend to have a good stock market. That's all we have this week. It's a pretty full chart pack, so hope you've enjoyed it. We'll talk to you again soon. Have a great week.